The CU 2.0 podcast.
Cliff Rosenthal literally wrote the book on CDFIs, that's Community Development Financial Institutions. Hear his story in this podcast. It dates back to 2019. It's episode 37 in the vaults. 37. Rosenthal was on the show last year, episode 311, talking about a new book he co-authored with Michael McRae entitled Community Capital. That's part Rosenthal autobiography, part the story of the death, the murder of an African-American credit union. Hard-hitting stuff. But the CDFI story starts here in episode 37, and it's now our greatest hit, number 24. Listen up.
The CU 2.0 podcast.
Welcome to the CU 2.0 podcast. This is your host, Robert McGarvey. Today's guest, Cliff Rosenthal. He's the man who literally wrote the book on community financial development institutions. He's also a man who knows pretty much everything there is to know about the history of credit unions, which he's written about in his book too. We talk about that book, Democratizing Finance, in this wide-ranging, interesting, provocative podcast. It's a podcast where you will hear opinions, pretty strong opinions about credit union reaction to the CFPB, where Cliff served for a time as an administrator. You'll also hear about credit union executives who don't necessarily want to lend to or serve the poor. Is that really an integral part of the credit union mission? Is that essential for being a good credit union executive, for being a good credit union? Interesting thoughts you'll hear in this podcast. It's a podcast that pulls no punches. Cliff is very open-minded in a lot of ways, so don't expect to hear anything dogmatic. You'll also hear about some true heroes of CDFI. People like Bill Bynum at Hope Credit Union, who sat for an early podcast in this series some months ago. You can listen to that, dig that up in the archives. Now, a scary factoid that Cliff gives us, and it's something for you to think about, in the early 1990s, there were about 13,000 banks and thrifts and a similar number of credit unions. Today, there are maybe 5,500 of each. He figures that in 10 years, there will be about 3,000 credit unions. When does the number get too small to count? When is that happening? I'm not sure, but that day may come. Now, he also insists that for many credit unions that focus on community development, the margins are better. It's in some ways easier to succeed doing that. Why? Well, you're not competing with Chase. You're not competing against Bank of America. You have customers, members that they just don't want to serve. Playing field is open. Get to do good. Also run a good, successful institution. Something to think about.
I'm looking forward to this. We actually have a minor news hook, if you will, here to discuss.
Oh, yes.
Which is the Sanders-Ocasio-Cortez proposal to enlist post offices as kind of banks, which, as I'm sure you know, both trades have attacked as stealing a baby's milk. And how sincere are they in that attack? And is there anything, in fact, wrong with this proposal?
Well, I haven't seen the details of the proposal. In a former capacity, I did manage to see what was an original concept for this a number of years ago, which frankly at the time didn't impress me much as a business plan. I've got to assume that some more thought has gone into it since. But, I need to be convinced that this is a viable idea. As you probably know, the postal system itself is in significant trouble, partly not through their own doings because of some machinations in terms of how they were supposed to record their pension obligations. So the post office system itself is not on sound financial footing. And I guess I have sort of an instinctive reaction against hooking a new and untried initiative as perhaps in part at least a bailout for an existing system that's in some trouble.
I don't disagree with you. On the other hand, something bothers me about the virulence of the opposition of the trade associations, where the way I see the numbers, roughly 25% of households in America are underbanked or unbanked, and which tells me some financial institutions, including many credit unions, don't want them.
Yeah.
And if you don't want them, why do you care if they go someplace else? Who cares?
I think you need to disaggregate those questions. I mean, one of them is the issue of competition from credit unions, and I hear you. And certainly the virulence of the response is something that makes me very very uncomfortable. Credit unions should not need to fear this other entity coming into the business. Whether that other entity makes sense in terms of the overall public policy, that's really a different question. So I'm with you in terms of having a dismay at the virulence of the response. I guess the context that I see it, and as you know, I've recently published my book, Democratizing Finance, Origins of the Community Development Financial Institutions Movement, which takes a look back at the origins of the credit union movement as a genuinely working class populist movement that really was created in order to address the issues of usury at the time. So it gives me, a lot of dismay to think that 110 some odd years after the birth of credit unions in the United States, we still have such a significant problem of unbanked and underbanked people.
And credit unions were founded, and you know this much better than I do, when a guy needed $500 to put a new roof on his house or to buy a used car to get to work, banks didn't want his business. They didn't want to make the loan. So he could either go to a loan shark, he could go to legal loan sharks like household finance or beneficial finance, or in some cases, if he worked at a factory with a credit union, he could borrow money from there, and that was the best deal of all.
Absolutely. Those are the roots of credit unions, and I'd like to think that those sorts of loans are still possible and practiced by credit unions, certainly more than banks. But nonetheless, there are obviously significant gaps in financial security among a large portion of the population today.
In your book, you also talk about the ambivalence of many credit unions to, let's call it, community development financial activities, where at least some credit unions really didn't see that as the road they wanted to go down. Some didn't see it as the road to their financial security. Am I right about that?
I think you are, and I think as I study the history, including some of the early works that are out there, there has been this ambivalence within the credit union movement that there's certainly over the last half century in the United States, there's been a growing middle class, which represented a pretty good fit for credit unions, a secure population to loan to, and so forth, that needed those financial services. Going out further on the risk spectrum to people who are like the B, C, and D credits is not something that a good portion of the credit union industry has been comfortable with for many years. I see encouraging signs in the respect of more credit unions, including some rather large ones, multi-billion-dollar ones, refocusing and getting more into community development. Certainly that hasn't been the main focus of the credit union movement as we've seen it over the last 30, 40 years.
Now, you worked at the CFPB, right?
That's correct, for 2 years, almost 2 years.
Now, I remember being at a GAC meeting shortly after CFPB came into business. And the sense I got was that many credit union executives had finally seen Satan, and Satan was the CFPB.
Yes.
Which shocked me because I thought the CFPB was the enemy of predatory banks. And I wrote about that. People weren't really pleased about my opinion. Did I interpret that reaction among many in the credit union industry correctly? And if I did, were you surprised by that? Because it surprised the heck out of me. These are your friends, man.
Yeah, your perception is absolutely accurate. I remember going to the GAC a month or two before I went to the CFPB, but the fact that I was going over to the CFPB was already public information. And any number of credit union colleagues for many years, either facetiously, semi-facetiously, or not facetiously at all, said, "Oh, you're going over to the dark side." Let me put it this way. For many decades, NCUA was, quote, the enemy. NCUA regulations were what people focused their negative energy on. Then CFPB came along, and I think CFPB replaced NCUA as the most hated regulator. And that was a source of considerable dismay to me also, because I do think that the CFPB overall has been a very important ally for consumers, and I would certainly like to think that credit unions are on the side of consumers.
That to me is the exact nub of this, where CFPB is formed to protect consumers, and credit unions supposedly are in the business of being friends to consumers. So why aren't you allies?
Basically, it's about regulation. Credit unions don't want more regulation, pure and simple. I'm sympathetic to a degree on it, particularly the small credit unions, have an increasingly difficult time keeping up with the compliance requirements, the cybersecurity needs, and so forth. It's a very, very tough business for small credit unions. The large ones, I perhaps have a little less sympathy for. If you're a $10 billion, $50 billion credit union, of which there are few at least now, I think you have considerable capacity. What dismayed me as well was that on some issues, such as the mortgage lending regulations, there was, as you say, a virulent response on the part of credit unions. To some degree, we saw, let's say, consulting and legal firms whipping up the opposition to it and threatening all sorts of dire consequences that really scared some credit unions, even ones that weren't in the mortgage business or were doing so little of it that they wouldn't have been affected. Cynically, I've got to say this is the nature of the business, the trade association business, and the vendor business as well. That you certainly highlight worst case scenarios, some of which may happen, but many of which are not relevant, and you do that to increase business. Fighting the regulators is good business for a significant segment out there.
Well, I think where you see that really clearly is with alleged threats to the no tax status for credit unions. And
yes,
I've talked at GAC with what I call shoebox credit unions, that we're going to go protest their member of the House about taxing credit unions. These guys, they didn't have any taxes to pay. Not in a trillion years. Yeah. So why are you going to protest this? Well, and that's because they were whipped up by the trade associations that this was evil.
There's a symbiotic relationship, it seems to me, between the lobbyists for credit unions and the lobbyists for the banking industries. That each of them, a significant portion of their work, is involved in fending off, in repelling the attacks of the others.
What I think is saddest about that is that credit unions have much more in common with community banks than with any other kinds of institutions. And I see them both as somewhat endangered species, where non-banks are chewing up some of the business on one side, and then the big banks just get bigger and bigger. It's like the Walmart effect. I mean, when we were kids, every town had 1,000 independent pharmacies and 1,000 independent hardware stores. I live in Phoenix, and I could maybe take you to one independent pharmacy, I think. There's one that I know. Phoenix is the 5th biggest city. And I see the same thing happening with community banks and credit unions.
Well, I don't know if their interests are aligned. I think that there are some real competitive factors, particularly in smaller markets or where credit unions are quite large. So there is a basis for, competition between them. But I think you're right in the sense that the dynamics of the financial industry are basically undeniable. It's the concentration of financial assets, particularly deposits, in a smaller number of larger institutions. And this has been aggravated and accelerated by the Great Recession. More and more money in the biggest banks of the United States. Community banks certainly have been threatened by this. They find it very difficult to approach the capital markets and raise additional funds. Statistic I generally like to cite is this: by the early 90s, there were approximately 13,000 banks plus thrifts on the one hand, and almost the same number of credit unions on the other hand. Today, there are about 5,500 of each of those respective institutions. So I think the trend is certainly very clear. A smaller number of generally larger institutions. And I don't think I have to tell you that the number of credit unions in the United States is declining by, in an average year, 200 or 300 institutions. So if you look at the handwriting on the wall, 10 years from now, there'll probably be 3,000, 3,500 credit unions in the United States.
And I remember Jim Blaine telling me some years ago that his best friends politically were the smallest credit unions because they were the ones who got sympathy from legislators. And he said,
yes.
when I go in, I'm just another banker. And I think Jim was somewhat exaggerating how he was viewed.
Poor Jim. Yes, I know.
But I was always touched that he said, really, I want these people with me because they are seen as the face of the local community. I'm not.
That's right. This, despite the fact that that State Employees Credit Union, I think, is one of the best community-oriented credit unions in the country with 200 branches around the state. But yeah, sure, Jim Blaine, when he was there, was certainly seen as the big bad credit union by some folks.
Well, he also has in North Carolina a huge fleet of fee-free ATMs.
Yeah. Mm-hmm.
And part of the reason he told me was to torment Bank of America, but the other part was to benefit small credit unions. His advice to them is tell your members come use ours. They're not going to pay a fee.
And that's great. And he particularly provided back office support to the Latino Community Credit Union, based in Durham, but with about 11 branches, which is really the most successful CDCU startup of the last 20 years in bringing services to low income and minority and other groups. Serves a largely immigrant population, grew from nothing in the year 2000 to several hundred million in assets with maybe 70,000 members. And this has been possible in large part due to the help of two institutions. One is Self-Help in Durham, and the other is State Employees Credit Union. So he's really delivered a lot in terms of helping to bring services to disadvantaged communities.
Well, he's a guy who I always thought truly was a credit union guy, where some credit union CEOs I see as wannabe bankers.
Yeah.
And they made the wrong turn in life, so they took the low-paying job instead.
I don't know how low pay it is now either, to tell you the truth.
Now, should every credit union be a CDFI?
I don't think so. I mean, it's not simply a designation. You have to have a mission and a focus and a target market for which that makes sense. And there are many communities in the United States that are doing just fine. They don't need institutions specifically focused on community development. There are folks working in various industries and trades who are doing pretty well. Credit unions are important for them. They provide great service. And there's not really a mandate for every single credit union in the United States to become a community development institution. I would hope that every credit union in the United States would offer accessible credit in small amounts at reasonable rates and would not restrict itself only to the A credits, but it does not mean that they have to become a CDFI.
Now, let's go back to a point we touched on. Do most credit unions actually want low-income members?
I don't know. You'd probably have to ask them. I think it would be rare to have some that would say, gee, we really don't want those folks here. On the other hand, their policies may not be particularly attractive to the small depositors or the small borrowers or immigrants and so forth. So I doubt that it's explicitly or obviously in any way some sort of signing or messaging that says we don't want you here. On the other hand, there are many institutions who probably do not particularly market to those segments of the population.
Well, you go into the big banks, they do not market into that population.
No.
I don't know that Chase would say on the record, geez, we don't really want poor people.
No, of course not.
But
of course not. Mm-hmm.
Off the record, they'd say, why'd you ask such a stupid question? Of course we don't want them.
No, the objective fact is serving an account with $150 in it is not profitable. It's not profitable for bank, and it's not profitable for most credit unions either. You need a balance.
Your former job has a bunch of data that says that in many respects, community development financial institutions can be more competitive than credit unions that try to compete with big banks. And, I think about it. It's hard to compete and win against Chase. They're really good at what they do, and they're really rich. And they're so rich when they make a mistake, they can just move on and do something else. Whereas if you're competing for members whom no one particularly wants to serve,
yes,
it's kind of open playing field, and you get to feel good about what you're doing.
And in many cases, you probably can achieve a better margin because you're not competing for the last 25 basis points. You're probably making loans that are a bit more profitable, assuming people pay them back, which most people, including the great majority of low-income people, do.
Bill Bynum tells me he makes good money making those small dollar loans in Mississippi and Alabama.
Bill is an extraordinary leader who's done great work, and they've also managed, to my understanding, to bring mobile services to a population that's not predominantly seen as sort of a cutting edge or early adopter of mobile technology. So I think that's been powerful for Bill, and it's really essential because he serves a pretty widely scattered population, including folks who the nearest bank or nearest financial institution is not around the corner. To travel, to drive 30 miles, even to a local credit union, can be a little time consuming and even costly.
I actually did a story on him and that some years ago. I'm thinking 5 years ago. And he told me, and it's very obvious if you think about it, he said, my members don't have home computers. My members don't have home internet. So, yeah, we could have online banking, but who'd use it? Whereas they all have cell phones. And that's kind of the end of his argument. But you sit there and say, man, that's brilliant.
Yeah.
Yeah, and of course, there's the example from Kenya where something similar is playing out.
That's right. From Pesa, yes.
And he said stuff like this really helps people not overdraw their account, for instance. You don't have to guess what your balance is. Just look, man. It's in your pocket. It's in your phone.
Right.
And so I view him as a great innovator who's showing that you can serve people, but you can also be a successful institution if you want to.
Yeah, I think they're really outstanding.
And he's also profited, and I don't use the word profit in terms of finances, from essentially being given branches that banks didn't want.
That's right.
I think he's picked up 6 or so in recent years. And he's expanded into markets like Birmingham, Alabama, that one bank was pulling out of, and said, hey, you want the branches? And he said, sure.
Right. Some of them I think he's had to pay for, and they were not necessarily the most attractive franchises. He's gone not necessarily because it was a great business opportunity, but because really they were the last institution in town.
Yep.
And around. So, yeah. So, I think it's great if some of them have been profitable. I know Bill has done some of those deals, even though it didn't look like a great business.
Well, he's, as you know, truly passionate and evangelical about the need to bring basic financial services to an unserved population. That is just plain wrong not to bring these services to them. And then it's up to them to use them. But he views this as a mission. It's something one should do. And I agree with him. I assume you agree with him, too, on that.
Absolutely. And I think Bill is one of the heroes of this movement.
So what's the future of CDFIs?
I would say that the future of CDFIs is good, almost surprisingly good. 3 years ago, 3 years ago, after the election, I was rather concerned with what was going to become of this movement. Credit unions are not dependent on CDFI, the CDFI fund and its appropriations. Many other CDFIs, particularly the nonprofit loan funds, are. And I think that there was a real fear that the CDFI fund, which is sort of at the epicenter of this, would be abolished. And indeed, 3 successive OMB submissions for this administration called for essentially the elimination of the CDFI fund. I suspected that had that happened, it would have led to considerable consolidation and retraction in the broader CDFI field. But in what it seems to me really remarkable political circumstance, there has been bipartisan support for the CDFI fund, so that the appropriations, notwithstanding OMB's request, the appropriations of the CDFI fund have been at near record levels for the last 2 years, and I expect for the third year as well. So in short, what I think that means is that community development finance, after 25 years of the CDFI fund, has established itself in the public policy and economic development arena pretty solidly. That it's, I would say, the most valued brand in community development. I'd say that more institutions, particularly more credit unions, and some that are quite substantial in size, have refocused their mission to become CDFIs. So that's a basis for my optimism that I think that this field is in pretty good shape and is going to be a part of the landscape for a good many years to come.
What would you point to as the greatest successes of CDFIs?
In my book, I try to look at a 200-year history of efforts to provide access to capital and credit for excluded communities, people who are excluded on the basis of poverty, on the basis of race, on the basis of geography. And it's taken at various times a combination of philanthropy, government intervention, and grassroots movement to bring a success such as what CDFI has represented. I think the major innovation of the CDFI fund is this, that it's not a loan program primarily. CDFI fund invests capital, equity capital, grants, if you will, in institutions. It's engaged in institution building, not simply repeating a year-to-year program that provides a little operating support, a little project support, something like that. It's built institutions that make credit decisions and investment decisions based on local needs. I think that really distinguishes it from any of the other efforts over the, certainly the last 50 years and arguably the last 200 years to provide financial access to excluded communities.
And you say that CDFIs have had bipartisan support.
Right.
That's very unusual in Washington.
That's my point. It's pretty close to unique, and particularly, this is a domestic policy. Sometimes you can get agreement on foreign policy, though not so much lately. But in terms of domestic policy and an appropriated program that requires federal funding, I think it's really quite rare for an effort like this to be pretty non-controversial and to win support from both sides of the aisle. So I give great credit to the folks who've led this field.
Now, do you call this is it an industry or a movement?
I talk quite a bit about that in my book. And what I basically wind up is describing this as a field. There are various types of CDFIs, credit unions, of course, community development banks, community development venture funds, microfinance funds, and so forth. They're basically siloed, if you will. There's not a tremendous amount of interaction between them. And, we're all collegial, work together, certainly share an interest in federal government providing support for this field. But I compare it to the origins of the credit union movement, which was truly a movement. As you know, it was largely funded in its first few decades by Edward Filene, who funds a campaign to establish state laws and to organize credit unions around the United States. And credit unions grew virally for the first half century. The credit unions were a disruptor in the best possible sense. Here you had working people, low-income people who otherwise would go to usurers, and the proselytizers for credit unions come along. They introduce the idea to people, and literally these credit unions spring up overnight. I describe a meeting in 1933 that Edward Filene goes to, in which there are 1,000 people. It's a mass meeting. Filene is up there. He's someone who's always been behind the scenes, never a charismatic person, but he's greeted ecstatically as someone who is really helps to transform the economic prospects of working people in this country. So there was really a movement, a very strong movement spirit there. There was a commitment to democracy at every level, from the local level in terms of how credit unions are structured, to really a vision of democracy worldwide that the cooperative movement would represent. So I never, honestly, though I was a co-founder of the CDFI movement and field, that I really wrote the first concept paper for it, it has never really been a transformational movement in the same way that credit unions were for much of their early history.
Well, banks did not want working class people as customers for all practical purposes.
Nor did they want credit unions, because, in these sort of state by state campaigns that Filene helped fund, banks and installment lenders strongly opposed the formation of credit unions.
That makes sense, and as we discussed, you still see some of that tension today.
You sure do.
Even though in many respects they should be the best allies, but they don't quite see it that way. So you're essentially optimistic.
I am now.
I think what continues to worry me is the growing income disparity, where we're almost returning to a period of the Middle Ages where a handful of people have 99.9% of the wealth, and the rest scramble with the little slivers left on the floor.
Yeah, I think inequality is a colossal issue for the United States, one with the potential to be politically and socially destabilizing. How do credit unions fit into it? Well, we're not income transfer mechanisms to reduce inequality in that sense, but what we can do for sure is mitigate the damage. I mean, the fact that people are going to payday lenders and parting with a substantial amount of their income to pay for interest and fees on this, it's a shame and it's an outrage. And to the degree that credit unions could put those sorts of lending mechanisms out of business by providing affordable, small to medium-sized credit, they can at least mitigate the damage of financial insecurity that so many people face in this country. I mean, you've seen the statistics, and they're really shocking. I mean, something like 40% of the households in this country could not come up with $400 for an unanticipated emergency expense.
And that's the thing. I've written some about so-called predatory lenders, pawn shops, payday loans. I've also talked with employees there. I've talked with customers of theirs. And you don't wake up in the morning saying, geez, I want to go get a payday loan. What you do is you wake up in the morning and your boyfriend's knocked your 2 front teeth out, and you need some money to patch that hole in your mouth. And who's going to give it to you? That's your problem. And are you a bad person for going to a payday loan? No. It's your only choice. You're doing what you can do. You go down to Chase, see if they'll give you $5,000 to fix your mouth. They ain't gonna, but give it a whirl. You can go to a credit union, see how you fare there. Payday loan guy will probably give you the loan. And that's the tragedy. We have these people with these immense needs that are legitimate needs. And we need to find ways that are better for all to fix those needs. And credit unions could be that part of that solution.
I agree. They could be, and some are, but more can and should be. That's why the credit unions were created, and I think that the need is not diminished. It's different. It looks different than it did 100 years ago. They're not usurers at the door, literally, that there were during the time of Edward Verleen. That's what got him into credit unions. I mean, that literally the workers would leave his plant every Friday and the usurers would be at the door. Well, it isn't like that so much.
Every factory in North Jersey and New York had a 5 for 6 guy. He'd lend you 5 and then you owed him 6 on payday next week.
Is that right? I haven't heard about this particular practice. No.
And usually that was the sum involved, $5. Because that's back when $5 was meaningful. You could buy a bag of groceries for $5.
Sure.
And most of them were organized crime connected or related. So there were threats of violence, et cetera, more implicit than heard. So that was this immense social problem well into the 50s. And I think what finally ended that problem was the proliferation of credit cards, where credit cards became a way to get a small dollar loan without any embarrassment.
I think that some of the tawdry stories, may not apply in the same way. I'm sure organized crime exists in lending at certain levels, but in low-income communities, there are informal lending arrangements, and it's not always the knee breakers that you see in the popular image. I mean, in Latino communities, they're called prestamistas, who make these small loans. It might be, just a bodega owner or in some cases a sanitation guy who knows the neighborhood and so forth. So the informal lending at high cost still does exist, particularly in low-income areas.
I've always been fascinated with alternative forms of lending, which I certainly see as not good, but I think what's overlooked oftentimes is the human need that propels the loan. And it's easy enough to say you shouldn't do that. And you shouldn't. But what if that's your only choice?
That's right.
I just wish credit unions would get a little more involved in this. And these are risky customers. I get it. But people like Bill Bynum and Self-Help are showing you can do this. It just takes a whole lot of energy and a certain amount of wit and wisdom.
It does. But I think that that it's sustainable if you do it right. And I think that the non-financial rewards of serving those communities are pretty substantial. I mean, if you go to talk to some of the folks who work in community development credit unions and others, I think you'll find folks with a pretty high level of job satisfaction, that they're doing something that's meaningful and really, really helping people. And, for in this world today, that's not such an easy situation to find.
Now, for a word from our sponsor. Are you looking to recapture members, increase your margins, live your mission? QCash is what you want to know about. That's because QCash delivers a fully automated small dollar short-term credit solution that allows credit unions to meet members' short-term cash needs. Accuso, it's dedicated to helping credit unions build financial stability and health for its members. Check out QCash at qcash.com. Before we go, the CU 2.0 podcast is looking for a few good sponsors to help us spread the word about the digital transformation of credit unions. You could be one of them. Contact Robert McGarvey for details at rjmcgarvey@gmail.com. First come, first served. Again, that's rjmcgarvey@gmail.com. The CU 2.0 podcast. The CU 2.0 podcast.